Thanks for that kind introduction. It's great to be back with you. I think I said last year I would come back when inflation got down, and so I'm really happy it has. Before I get started, I want to take a second just to acknowledge the challenges and the devastation in western North Carolina, and just say our thoughts are very much with those affected, and we're hoping for a speedy recovery. I thought today I might talk more, though, about the economy and where it might be headed, and then I'm very open to questions and comments on the back end. These are my thoughts alone, not those of anybody else in the Federal Reserve System. So just to get started, you probably saw this, but we cut rates 50 basis points at our meeting a couple weeks ago. That cut came largely because we've seen progress on inflation. 12-month headline PCE inflation is now down to 2.2%. Versus its peak of 7.1% in June of 2022. Core inflation is down to 2.7%. Near-term inflation expectations are back basically in line with our 2% target. And if you look at the most recent data, the information's even better. 3-month core inflation is now at 2.1%. And importantly, this decline in inflation seems like it's broad-based rather than just being in goods as it was last year. Now, this drop is being driven by consumers, and the way I like to think about it is people are still frustrated by high prices. And when you go in the store and you're frustrated by high prices, you become more price conscious. And so I see consumers still spending, but they're choosing. They're trading down from beef to chicken, from sit-down restaurants to fast casual, from brand names to private label. Consumers are waiting for promotions, opting for the $5 value meal at McDonald's, or jumping at discounts at Target. And I'll just say that's how it's supposed to work. When you raise prices, consumers are supposed to respond, and the old saying is the solution to high prices is high prices. And that's what we're seeing. Consumers are making choices, and these choices are pressing price setters to finally moderate their price increases. Now, at times in the past, the Fed has made a significant cut in response to a troubled economy. And happily, that's not the case today. As inflation has come down, economic activity has remained robust. GDP growth came in at 3% in the second quarter. That's a more than healthy growth rate. Consumer spending, which is roughly 70% of GDP, is even higher at 3.1%. And that's being supported by low unemployment, higher real wages, and high valuations. And thanks in part to all this strong spending, the U.S. economy has now returned to its pre-pandemic GDP growth trend. In other words, we went down during the pandemic. We're not just back to where we were before, we're back on where the trend line was. And that's something that didn't happen after the Great Recession. And so that's something that hasn't happened in most other developed countries. The labor market has remained in good shape too. We've added 116,000 jobs on average over the last 3 months. Unemployment's ticked up, but it remains low at 4.2%, which is near what most people estimate as its natural rate. And given how overheated labor markets were a couple years ago, it shouldn't be surprising that we've had some normalization here. Okay, so why did the FOMC reduce rates so significantly if we're not seeing a troubled economy and we're not seeing a weak labor market? And I guess I would just describe this as a recalibration to a somewhat less restrictive stance. We'd had rates at 5.3% for over a year, and with that, headline inflation come down pretty close to target. Unemployment was pretty close to its natural rate. The number that now seemed a little bit out of sync was the Fed funds rate. It just didn't need to be quite as restrictive given the progress that's been made. And going forward, the median member of the FOMC forecasted another 50 basis points in cuts this year, assuming the data comes in as expected. And I just say it's a dial back in restraint, and just think of it as taking a little bit of the edge off. Now, I assume there are 1 or 2 people in this room who are happy to see us start to bring rates down. That was supposed to be a joke. But please remember that our focus has not been on the rates. Our focus has been on inflation. If we learned anything in the last 3 years, it's how much we each hate inflation, hate that it's unfair, hate that it's exhausting, hate that it creates uncertainty. And high rates are the tool we have to get inflation under control. And I've been glad to see that that's been done with limited collateral damage, at least to date. So you might then ask, all right, does this cut mean that we're declaring victory? And let me start with some history. A few of you will remember this. Let's declare victory and go home is actually a pretty cynical phrase, which you could trace back to the 60s when Senator George Aiken of Vermont proposed that the U.S. should call Vietnam a win and begin to de-escalate, regardless of the realities on the ground. As an aside, it's never good if your strategy looks like one from Vietnam. So I'm not yet confident nor cynical enough to declare victory, and I'll give you 3 reasons for that. First, victory just means different things to different people. I talked to a lot of people for whom victory would be returning to the interest rates that we saw in 2021 or returning to the pre-pandemic price levels. And I just say both of those are going to be very challenging absent a significant recession, which I venture to say would not be considered a win. Others define victory as a stock market that continually goes up and up and up, but of course we don't and we can't seek to control the stock market. And some just yearn for the stability of the 2010s, when GDP grew every year, employment grew every year, and inflation barely moved. And I'll just say that decade was pretty unique in recent economic history. And I'll just say, because of all that, declaring victory just feels bound to disappoint. But the second reason not to declare victory is there's still work to do on inflation. It's down from our high, but it's still above our 2% target. And it's unlikely to drop on a 12-month basis until at best early next year, because the last half of last year was so good and we're rounding over those comps. How do you forecast inflation going forward? It's pretty challenging. On the positive side, we may well get help from supply side factors like immigration, like increased labor force participation, and like productivity, as well as global factors like disinflation coming from China and increased energy production. Last I saw, per barrel oil prices were still down in the 70s. On the other hand, I just got my homeowner's insurance renewal, and it reminded me that inflationary pressures have not fully disappeared. Apologies to any insurance agents that might be here. You know, recent union actions like the ones we're seeing in the ports or a pullback in labor supply could drive higher wages. Healthcare cost trends could raise premiums further. Deglobalization could increase import prices. And the conflict that we're seeing in the Middle East could easily worsen. I'm paying particular attention to the impact of our recent moves on the prices of cars and houses. Buyers are absolutely going to welcome lower rates, but there's a risk here that we stimulate demand in excess of available supply. Remember, it takes time to get a new house built or move a car onto an auto dealer's lot. There are locked-in homeowners who may well start to list their homes as mortgage rates drop, but these sellers are also going to be buyers, increasing demand while they're adding to supply. So it remains difficult just to declare that the inflation battle's been won. A third reason not to declare victory is the labor market, which still has risks. The levels, as I mentioned, look healthy, but the trends bear watching. Job gains are being continually revised down. We'll get another report on Friday. And those sectors like healthcare, which have been catching up from pandemic shortages, are starting to moderate their growth. In fact, the hiring rate now has dropped all the way back to 2013 levels. But while employers aren't hiring, they're also not firing. The layoff rate is very close to its 25-year low. Initial claims remain muted. And what I hear happening, maybe some of you are doing this as well, is employers are just cautious. They're allowing headcount to drift downward, but largely through attrition. I hear very few employers planning layoffs, and you know that layoffs do take time to plan. This low hiring, low firing environment is unlikely to persist, but again, I could make a case it could evolve in either direction. Of course, we could see a cycle of layoffs starting given profit pressures, excess staffing that many have chosen to keep after their pandemic-era shortages. But as long as demand remains healthy, you could also see the other side happening, which is lower rates spur some momentum, and those employers running lean could well find themselves short again, particularly if labor force growth starts to slow. At some point, you're going to need to hire to serve your customers. So you might notice that I'm wearing a suit. I'm not wearing a mission accomplished bomber jacket. It's not that I'm particularly humble, and it's not that I'm particularly formal. I'm just realistic. Victory means different things to different people. And while we've made real progress, there's still significant uncertainty on both inflation and unemployment. And while we are working hard to deliver for the U.S. economy, recognize that it's very hard to get this perfect. Perfection's a high bar. We operate in an environment, fraught with uncertainty. Just think of the port strike or the Iranian missile launch yesterday. we're under a mandate requiring trade-offs between unemployment and inflation. And our primary tool, the Fed funds rate, works with long and variable lags and without a finish line. So we're just going to have to be attentive and learn as we go as we decide how fast we need to move and how far to go during this rate reduction cycle. And I really am looking forward to your questions and comments today, and thank you for your time.